So here's the question. Are the recent gyrations in the financial markets around the world just a blip or the start of something more substantial? Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. This is a short piece with my own thoughts on the current situation with regard to the financial markets and what might be ahead. This is by no way financial advice, it's simply my own perspective. So in the last 2 or 3 days, we've seen a significant short-term correction, and the volatility index, or the fear index, is now up to a very high level. In fact, only 4 times since 1990 has the volatility index been this high. And of course, this is after many months of almost no volatility and a steady climb in share values both in the US and locally in Australia. But now we've seen a correction. So the key question is it just a little blip or is it something more significant? Well, it's interesting that quite a few of the analysts today are making the points that the markets have just retraced their steps from the end of last year. And so in absolute terms, they're still quite high relative to even 6 months ago. But we have the feeling that this is perhaps more significant than it is currently being given credit for. Let me try and explain why. The first thing to understand is there is a reason why the markets in the US have changed. And essentially, it's all to do with a perception about where interest rates are going to go. Now, at the end of last week, there was some data on employment and wage growth, which was significantly more positive than many people thought. And this then started to trigger a recognition that the current level of interest rates, which are very low in the US still, are due to move up. So we knew this anyway because the Fed had been signalling this movement up for some time. But now it's clear that it is really going to happen. And of course, it's also a switch to a new Fed chair as well, which may be bringing some uncertainty to the mix. So interest rates are due to rise in the US. And as Greenspan said last week, the problem is that people have forgotten that there are huge deficits in the US, and those need to be paid for. So essentially, as interest rates rise, the cost of public debt in the US is going to rise significantly. And we've also got high corporate debt in the US, and also some relatively high levels of consumer debt in the US. All of this will conspire to put pressure on the economy. Now, the economy may continue to grow, and of course the recent tax cuts in the US have brought forward potential investment and essentially has given a bit of a kick. But it's a temporary kick. And so the question is, what's going to happen in the medium term? Now, as rates in the US rise, that's going to have a spillover effect more broadly into the capital markets. And Australian banks in particular are very sensitive to what happens to the capital markets because they borrow in the international markets to fund their book, somewhere between 30 and 40% of their book. Whatever happens here from the Reserve Bank's perspective, we're going to see upward pressure on interest rates. Now, as rates rise, everybody then has to pay more. And that's true whether it's government debt or private sector debt. Now here, of course, we have a significant overhang of private sector debt. And as interest rates move up, even just a little, we know that more households are going to get into significant difficulties with making those mortgage repayments and repaying those other loans. But there's another perspective too, and that is that interest rates in the US will have an impact on the currency here too. And it may well be that we find that the currency moves against us, which makes it more difficult for us to be competitive in the international markets. And it may be also that we actually end up paying more to fund our debt. We will know in a few days whether this is just a temporary correction or whether it is something more significant and more serious. But if you think back over the last 2 or 3 years, asset prices have risen significantly above their long-term normal levels. That's home prices, that's stock prices, and other assets too. And it's all to do with the fact that interest rates have been artificially low and quantitative easing has flooded the market with cheap money looking for a home. If this is the start of a reversal to more normal times, then essentially this market correction could certainly continue for quite some time, and we could be surprised on the downside as to how far prices correct. But there's also a spillover insofar that if asset prices start to shrink, this will put significant additional pressure on home prices in Australia. And that could well mean that the property sector also takes a bit of a bath locally. Now, the Reserve Bank has very little firepower left because the current interest rate setting at 1.5% means there is very little leeway. The bank may have to use some of that firepower to try and sustain the economy. But the problem is I can't see where the next round of momentum is coming from. I don't think tax cuts will make a particular difference to the scenario. I don't think that we can expect the household sector to spend more, given that effectively incomes are flat, static, and households are under significant pressure. So the question I have is, where is that next growth engine going to come from in a rising interest rate environment, in a market where financial markets around the world are getting repositioned and revalued? So it looks to me as though the next few months could be quite difficult for us here in Australia and more broadly in other countries as well. And the bottom line is this: our financial system globally is predicated on high asset prices and low interest rates. And in a way, we have not fixed the fundamental issues that were actually evident back in 2007, 8 and 9. Now, whilst our financial system is benefiting from high capital ratios and that the banks are therefore more protected, we have to bear in mind that many banks, particularly in Australia, would still be deemed too big to fail. And as a result, if they started to get into difficulty because mortgage delinquency started to rise and funding costs started to rise, the chances are they would have to be bailed out. But that risk in itself will add more uncertainty to the market and potentially create more of a spiral. So my take, and this is day 3 of the correction, so we'll see in a few weeks whether I'm right or whether I'm wrong, is that this is more than just a blip. It is more substantive in terms of correction, and nobody quite knows how this is going to end up. If you found this useful, do add a comment, subscribe to receive future updates, or like the post. I'm Martin North, Principal of Digital Finance Analytics. Many thanks for taking the time to watch.